Hello and welcome to the Engaging Economics webinar series brought to you by the Master of Science in Applied Economics program, the Master of Science in Financial Economics program, and the Johns Hopkins University Office of Advanced Academic Programs. Today's event features a discussion with Dr. Laurence Ball discussing taming U.S. inflation. My name is Peter Huggins and I'm the event producer. Please note today's event will be recorded and uploaded to the AAP YouTube channel under the Engaging Economics playlist. During the program, if you have any questions, please feel free to use the Q&A function, and we'll answer as many questions as possible during the Q&A portion of the event. With that, I will turn over the event to our moderator, Dr. Prakash Langani, Program Director and Senior Lecturer for the Master of Science in Applied Economics program.
Thanks very much, Peter. Welcome to our new webinar series. As Peter mentioned, I'm the director of the MS in Applied Economics program. I will be taking turns moderating the various events we have in this series with my colleague, Dr. Oh Hu, who's the director for our new MS in Financial Economics, and with our associate director, Dr. Xiaobing Zhao. Thank you. So today we're going to be discussing the prospects for U.S. inflation. We are lucky that one of the preeminent scholars in this field, Laurence Ball, is our program chair. So we will be talking first with him. And we are also delighted to have Mark Zandi, the chief economist for Moody's Analytics. So we will bring him in as well into the conversation. So let's start with you, Larry. Can you sort of take us back to our teenage years and talk to us about what U.S. inflation was like in those days, what has happened since, and how the recent flare-up in inflation compares to what has happened in the past, particularly in the 70s?
Yes, I feel nostalgic for my teenage years and listening to President Ford say inflation is public enemy number one. So, yeah, for those of you who weren't alive then, probably a lot of the audience, that was really the traumatic experience that has shaped monetary policy and thinking about inflation ever since. So inflation was high throughout the decade, and we had the two episodes of double-digit inflation, when inflation spiked above 10%. After the first big OPEC oil price increase in 1973, and then after the second big oil price increase in 1979, which doomed Jimmy Carter's career and brought Ronald Reagan into the presidency to a large degree. So that was the 70s. And then in the early 1980s, the Fed under Chairman Paul Volcker reduced inflation drastically at the cost of very tight monetary policy and a deep recession with 10% unemployment. But once Volcker did the job, then since the early 1980s, inflation has been quite low. And really for the last quarter of a century, since the 1990s, it's been very close to the Fed's target of 2% inflation. And in contrast, in the 1970s, until recently, inflation had really dropped out of the public consciousness as the big issue. And it was awkward teaching undergraduates and talking a lot about inflation. And they were thinking, why are they emphasizing this outmoded economic problem that doesn't exist anymore? But of course, that's changed a lot in the last couple of years.
So how big was the flare-up that we had in the last couple of years compared to what we've experienced in the U.S. history? Was this a big deal or not such a big deal?
It was a pretty big deal. I mean, inflation started rising quite shockingly rapidly in the spring of 2021. And famously, many economists, including Fed officials and certainly including me, at first were fairly untroubled, thinking this is a very transitory phenomenon involving certain industries, it'll go away. there was the unpleasant realization for a lot of us that inflation proved to be quite persistent. Basically, in the summer of 2022, it reached close to 9%. So not quite literally double digits, not quite the 1970s, but again, really shocking given that we'd come to think we lived in a world where inflation was really anchored at 2%. And if it went to 2.9%, that was an upsurge in inflation. Relative to the last quarter century of history, this is a big deal.
So, I know by the standards of economics, this is still recent developments, but do we already think we understand what caused this recent flare-up in inflation?
Well, a number of economists think they understand it. Of course, they think different things, but I would say there's a consensus maybe around two broad factors. One is just a collection of unfortunate events in certain industries where prices spiked up. A remarkably large amount of the total inflation, if you do the arithmetic, had to do with car prices, especially used car prices. They skyrocketed so much. There were other industries, and of course, towards the end of 2021, oil prices started rising very rapidly. That was exacerbated by the war in Ukraine. So there were a bunch of just unfortunate sector-specific shocks. So that's sort of general factor number one. General factor number two, I think most people would say, is the overheating of the labor market. The unemployment rate has been low, not astoundingly low by historical standards, but what's really been very unusual is the very large number of job openings or vacancies. So in summer 2022, there were almost two job openings for every unemployed workers, basically a big labor shortage as the economy ramped up and firms tried to hire workers to produce more and couldn't find enough workers. And that labor shortage, I think most people agree, caused wages to grow more rapidly, which sounds like a good thing until you realize then that higher wage growth gets passed through into a higher price inflation. So I think those are the two big factors. At this point, I think most of the idiosyncratic events in different industries have gone away or gone into reverse. Oil prices, of course, have fallen quite a bit in recent months. But the labor market is still overheated. The job openings are not at the record levels they were a year ago, but they're still quite high by historical standards. And I think the labor market still being fairly overheated is the main barrier towards getting inflation back down to the Fed's target.
Thanks. The other question I wanted to ask you was, I think when I read discussions in the media or on Twitter or X, I still feel that people wonder why economists focus so much on core inflation. I don't want to give away what Mark may say, but the first response to his recent post was to say, well, it seems that if I don't need to eat and if I don't need to live anywhere and I don't need to put gas in my car, inflation is doing fine. So could you, based on the data release that just came out this morning at 8:30, sort of tell us what was in that data release? What did it portend for inflation? And also, if you could demystify why economists set stock by core inflation, where to the normal person on the street, it seems like headline inflation is what you should be focusing on.
Okay, well, there are a number of issues there. Sort of on the basic role of core inflation, I think for a long time, really going back to the 70s, economists have thought that in the short run, month to month, that inflation movements can be heavily influenced or distorted by events in particular industries. Oil prices in particular go up one month, down the next month, and you get a very volatile series. There's an effort to try to figure out, well, what's the underlying or core level of inflation that captures really the inflationary state of the economy today and tells us about prospects for the future, and therefore is relevant for policy. So it's not, I think everybody agrees, headline inflation is the cost of living. That's what people pay, that's what matters. But arguably, in understanding where that's going in the future, current headline inflation can be distorted. It's more informative to look at some measure of core. Now how you do that is a complicated issue. The traditional measure that the Fed uses is the inflation rate excluding food and energy prices, and that takes out transitory blips in inflation in the food and energy industries. The one thing which is clear from the pandemic, although there was evidence before, is that we can have big shocks to other industries besides food and energy. So I mentioned the big increase in used car prices, which caused an upward blip in the summer of 2021. Also during the pandemic, with the shutdown and reopening, there were wild swings in the prices of hotels and airlines and things related to travel. So I think a good measure of core inflation should take those things out also. My favorite measure of core inflation is the weighted median inflation rate from the Federal Reserve Bank of Cleveland, which essentially, I don't know how much detail to go into, but looks at the distribution of industry price changes and looks at the industry in the middle of the distribution as kind of the typical inflation rate. And I think that's a good measure of core.
So what did today's 8:30 release from the BLS, and what did the noon time release from the Cleveland Fed? What do you think that told us about inflation, and how would you answer the question of this webinar, is victory in sight?
So before the releases today, I would have said whether victory is in sight, and here I'll sound like an academic, it depends how you define victory. If victory means getting inflation down to 3 or 4%, which is the economy can live with unemployment low, maybe we're pretty close to that kind of victory. If you really define victory, if you take literally how the Fed defines victory, which means getting inflation all the way down to its goal of 2.00%, then I think there's reason to think that wringing the last percentage point or two of extra inflation out of the economy could be quite a slog and would probably require tighter policy and a rise in unemployment. That's all before today. I would say today, the Cleveland Fed median, I think maybe Mark can comment on the 8:30 a.m. release, because I focused so much on the Cleveland Fed median a few hours later. And that actually was not good. The median inflation rate jumped up in a way which is not captured in the 8:30 a.m. measures. And actually over the last 12 months, the Cleveland Fed median CPI inflation rate is 5.5%. So by that measure, which I tend to look at, we're pretty far from victory.
Thanks very much, Larry. That's an honest and sobering look. I'll turn to Mark. I just wanted to recognize that my friend Gay Kororatan has joined us. She used to be at the National Association for Realtors and is now in Florida in a similar role. So she may have some questions for the both of you as well. But let me now turn to Mark, who is the chief economist at Moody's Analytics. I'm sure has been very busy all day on Bloomberg and CNN. So Mark, really appreciate you making the time to talk to our faculty, students, and our Johns Hopkins circles. I should say that Mark has been a big supporter of my webinars. He helped launch my webinar when I was at the IMF in their PR department. He also helped me launch our webinar when I was in the independent evaluation office of the IMF. So I could not think of launching a new webinar series now at Hopkins without having Mark there. So thanks very much, Mark. And let me turn it over to you. So broadly, the questions for you are, what did the 830 number, the latest CPI release, tell you about the prospects for US inflation? Would you say victory is in sight? And we will get to the Fed, but first let's just try to understand the numbers.
Sure. Well, Prakash, thank you for the opportunity. I had forgotten about those other webinars. Yeah.
You've been great.
I completely forgotten, but you're a good friend, and I appreciate the opportunity. And thank you, Johns Hopkins, and to be on with Professor Ball. I mean, that is pretty cool. So thank you for that opportunity. Let me just say, in my view, there are lots of reasons for the high inflation, demand and supply, but the predominant reason is the supply shocks the economy suffered through over the past several years. The most obvious being the pandemic, but I think the Russian war did a lot of damage as well, and that wrong-footed many forecasters because it kind of hit when people thought inflation would be moderating, that it would be transitory. But the Russian war caused oil prices to go to, I think at one point it was $125 a barrel. We were paying $5 for a gallon of regular unleaded, all-time record high back in when the CPI inflation was at 9%. And I think the other thing that was important is those two shocks conflated and caused inflation expectations to jump, particularly among consumers and workers. And that's when I think inflation kind of metastasized more broadly. Fears about wage and price dynamics started to take hold. And that's when central banks, including the Federal Reserve, went on high alert, DEFCON 1, and started raising rates very aggressively. So it was both those shocks and the fact that they came together and caused inflation expectations to jump that I think is at the root of the high inflation. If you buy into that kind of diagnosis, and it's a matter of endless debate, and will continue to be for debate for, I'm sure, 2 generations of economists, but if you buy into that, that would suggest that there's reason to be optimistic here, in that those shocks, the effects of those shocks, are fading. They're not gone. Larry mentioned vehicle prices. New vehicle prices are still elevated, in part because Japan and Germany are struggling with their supply chains. They haven't been able to get production back up to pre-pandemic levels. So new vehicle production globally has been impaired, limits supply, limits inventory, and has caused prices to remain very elevated. And by the way, that has enormous knock-on effects. For example, I don't know if you've noticed, but if you try to repair something with your car, or I don't know about you, but my auto insurance rates have gone skyward, and that goes back to price, because fixing a car is now a lot more expensive, and if it gets into an accident, it costs the insurance company a lot more. So the knock-on effects are quite significant. But if you buy into the fact that these things are fading and will continue to fade, that the inflation should moderate. It is moderating. We've made a lot of progress over the past more than a year. 9% at the peak. We're down to 4% core or top line, and we're headed in the right direction. And you got to, with that as context, then you take a look at today's numbers, and you can't I don't think you should be weighting any one number particularly high to a significant degree. You got to put it into a broader context. I thought the number was right to script. The actual numbers we got were exactly what were expected, so there was no surprise there. That's why financial markets kind of digested it reasonably gracefully. But the numbers themselves felt pretty good to me. The only surprise, if there was a surprise, was the cost of housing increased by 0.6%, and that's on the high side of what we've been getting, and not consistent with what we know. And what we know is that market rents, if I go out and I want to rent an apartment building or an apartment unit, and I have to pay rent, those market rents have been flat to down since the end of last year for against lots of reasons, mostly supply. We're now getting a lot of supply that got bottled up during the pandemic, couldn't complete because of supply chain issues, building materials, appliances, labor market issues, because a lot of immigrants tend to work in the construction trades. And so we got about 1 million multifamily units in the pipeline going to completion. So, but they're now coming into the market, and that's depressing rents. And the result is that should flow through to slower growth in the cost of housing services going forward by construction. In fact, Prakash, I forecast lots of things. This is what I do for a living. By the way,
Right.
we all forecast. It's just that I do this for a living. And some forecasts I am confident in, some not so much. I am confident that the growth in the cost of housing services is going to slow meaningfully over the next 6, 9, 12 months. And once that happens, that's going to bring inflation back down to the Federal Reserve target, or at least within spitting distance, of that.
Mark, we're going to have you back in 6 to 9
Yeah,
months.
and please do. I feel very highly confident in that estimate. And I'm going to end with one statistic in today's numbers. And back to the earlier point about core, we look at core because that gives you a better forecast of future inflation than actually looking at the top line with energy and food because of the volatility. So we look at core. Take a look at core CPI, Consumer Price Index. Take out the shelter component. That rose 0.1% in the month and is up 2% year over year through September. So, I'm overstating the case, obviously, but I'm making a case that if the growth in the cost of housing services continues to moderate, and by the way, and again, I'll repeat it, I feel very confident that that's going to happen. That suggests that everything else kind of stays roughly together. We don't get hit by another shock. Energy prices don't go skyward again for whatever reason. We should be back within, again, within a spitting distance of the Federal Reserve's target. Not next month. This is never a straight line. Not next quarter. Maybe not even early next year, but certainly by this time next year. That this, in fact, at the end of the day, was transitory. We just didn't count on the Russian invasion hitting in February of 2022.
Right. So as Peter told you, this is being recorded. So we're going to lead off 6, 9, 12 months from now.
I'm all about track records. Yeah.
Yeah. So can I ask you, this is a bit getting into the weeds, but the used car component, was there something unusual there in today's release, or it was what you expected?
It declined 2.5%, which is more than I anticipated. I think we were expecting, based on auction prices, something like 1 to 1.5%. Because auction prices lead what's in the CPI by a couple, 3 months. So we have a pretty good read on that. It probably goes to seasonal adjustment. That's the other reason why I don't pay any attention to any month to month, because seasonal adjustment is totally screwed up all the economic data because of the pandemic. It just scrambled all the normal seasonal patterns. So you can't read too much into any given month. So I never get overly worked up or overly optimistic about a month or 2 or even 3. You have to take a step back and take a look at, the general trend of things. And used car prices are down. If you look at auction prices today, that would suggest that in a month or 2 or 3, we're not going to see any further declines in used vehicle prices. We're pretty close to the bottom there. But new vehicle prices, once we're on the other side of the UAW strike and production normalizes here in North America, as we move into next year, hopefully the UAW strike will be over by then. I anticipate some meaningful declines in new vehicle prices, and that should also help in terms of getting inflation back down to the Fed's target by this time next year.
Okay. All right. So we'll interpret you as pretty much saying victory is in sight, and we'll bring you back next year if it's not, or even if it is, we will bring you back to do a victory lap. We'll bring you back regardless. So,
fair enough.
Mark, if I could continue with you for a few minutes more, let's think a bit about, what this means for how we think the Fed has done over the past 2 years. So, we'll turn to Larry Ball in a minute, and the professor, to give a grade. But if you can get us started in the discussion of how you think the Fed under Jay Powell has done in the last 2 years, and are there any lessons for the Fed from this episode going forward?
Well, I mean, under the circumstances, I think the Fed and Chair Powell have done a good job. They obviously made a mistake in managing policy in early 2022. They were too slow to start raising interest rates. But having said that, in the context of, kind of risk management, Risk Management 101 says if you're uncertain, err on the side of being too accommodative as opposed to being overly restrictive. And that's kind of sort of what they did. And it didn't work out for them in large part because the Russian war came out of nowhere and caused oil prices to rise. And again, that I think was really at the root of the significant increase in inflation expectations that occurred at the point in time. So they made a mistake, no doubt about it. But I'm not sure there's any way to avoid that given the circumstances that they needed to operate in. I will say, I was getting a little uncomfortable in early 2022, even before the Russian war. The Federal Reserve has this so-called reaction function. All the things they kind of look at to gauge what the appropriate policy is, and you can actually model that, right? But based on history, you can model it, and we've done that. And the model of the reaction function in January 2022. Prior to the Russian invasion, before oil prices took off and food and ag prices took off, said the federal funds rate target, the optimal federal funds rate target, given unemployment, given inflation expectations, given financial conditions, given the value of the dollar, all these things that the Fed looks at when trying to gauge policy, was saying the funds rate should be between 2 and 2.5%. So the model was saying, hey guys, we got to get going here. But again, risk management, because it's hard to remember back at that point in time, we were still, we'd just gotten out of the pandemic. We were very nervous about how that was going to all play out. And there's a lot of uncertainty around that. So it's hard to be overly critical of the Fed policy at the point in time because of the circumstances that existed, in my view.
Right. So what's your view on what they should do in November when they meet again, the Fed?
Absolutely, they should not tighten monetary policy. That, in my view, would be a mistake. They got the economy right where they want it. And by the way, I don't think that the labor market's overheated. I think it's, a 3.5% to 4% unemployment rate is consistent with full employment. You can feel it. The labor market has eased. Quit rates are down. They've come back to where they were pre-pandemic. That is a very good barometer of wage growth for lots of different reasons. So wage growth is moderating. Hours worked have been cut. They're back down to pre-pandemic levels. Hiring rates are down. They're back to pre-pandemic levels. I don't pay much attention at all to unfilled positions. I think that series is it's more noise than signal just because of changes in the way. I'm now speaking to you as an employer that hires a lot of people. I have a couple hundred economists around the world that work for me. And I have open positions, but I'll tell you, we'll slow walk those open positions. We just don't shut them down because you don't want to shut down the HR function in a large multinational, because once you shut it down, getting it back up is very painful, especially if you're going to experience a recession. So, and then you got the banking system. I've got this image in my mind, Prakash, of this financial system broadly, where the system is like an engine to a car, and it's shaking violently under the weight of interest rates. It blew a gasket back in March, and that's when the Fed stepped in with bank term funding program, ensuring depositors below and above the FDIC insurance limit for SVB, Silicon Valley Bank, and Signature Bank. They papered it over, but the system is still shaking, and the operating environment for the system is very bad. An inverted yield curve is really tough on financial institutions. They can't make money. Loan growth is weak because of a tightening in credit. Regulatory costs are rising. I think more regulations is prudent, but it's still raising the cost. You got credit problems that are developing, even if they're normalized. So, the longer rates stay, the higher rates go, and the longer they stay there, the more likely something in that system is going to break. The next thing that breaks may not be something the Fed can fix very easily. And I don't think that's necessary in the context of what I just said about inflation. Inflation is coming in, it's going to come in. And, I think the Fed's got the economy right where it needs it to be. They don't need to do anything more than what they've done.
Okay. Well, thanks, Mark. That was very clear, but we will hold you to your prediction and bring you back in 6, 9, 12 months, whenever. So let me turn to you, Larry, now for sort of the similar set of questions. You've been known to be a tough professor when it comes to grading the Fed from time to time. How would you both grade the Fed's recent performance, meaning over the last 2 years since the inflation flare-up, and also what would you recommend for their next meeting, what they should do at their next meeting in November?
Well, I'm very critical of the Fed for one decision 15 years ago to let Lehman Brothers fail. That's maybe a topic for a different day.
Right.
I mean, aside from that, I think the Fed's done pretty well. So as a professor, grading, depends very much what curve you use and who you compare it to. So sort of on a curve, if we think about compared to other policymaking institutions, the House of Representatives and so on, the Fed looks pretty good. And I think, I mostly agree with Mark that, if we could rewrite history, if we could go back in a time machine, we'd have knowing what we know today, we'd have the Fed start raising interest rates sooner, but it's very hard to fault them at the time for taking some time to realize that there was a problem. And, since they started raising rates, have seemed to have had a pretty balanced approach. I think in the end, maybe sometime Mark and I can have an in the weed discussion of different labor market indicators. I tend to put a lot of weight on the vacancies relative to unemployment. I think that's been a good predictor of inflation in the past. And by that measure, things are still, not normalized enough to expect the economy to drift back down to 2% inflation. So again, if I were deciding, I might tell the Fed to declare victory, even if that means keeping inflation at the current level of whatever it is, 3.5%, 4%. Again, where I might differ a little bit from Mark is I think that, under current policy, inflation's maybe not going to drift all the way down to 2.00 all by itself. That if the Fed really is serious about that, which I'm not sure they should be, but if we take them at their word, then they're going to have to tighten policy more, and there will be an uncomfortable increase in unemployment.
So in terms, I was trying to resist going there, but given your past work, would you be in favor of the Fed not just declaring victory at 3 or 4%, but actually raising the inflation target to 3 or 4%?
Well, that's an interesting, complicated topic. I'd say a qualified yes. I think from first principles, it's clear that a 4% target will be better than a 2% target, in my opinion, because that would get us farther away from the zero bound of interest rates and deal with that problem. It's tricky politically right now. If Jerome Powell's next press conference, he said, forget about that 2%, we really think 4% is right. So look, we've achieved our goal. That would not go over very well. That would look like a classic sort of moving the goalposts, So how they communicate, how they communicate that and deal with things over time, I'm not sure. But certainly someday, I think realizing that 4% is better than 2% would probably be a good step.
Mark, do you have a view on this? Should they not just declare victory, but say 3 or 4% is a good enough target?
I agree with Larry. I think 2% is the wrong target. I think 3% feels more appropriate to me in the context of, real potential growth. It's probably at best around 2, because otherwise, you're going to be hitting the zero lower bound consistently with every recession. Because I think the average decline in the funds rate during recession is 500 basis points, 5 percentage points. So if you're, 2% real, 2% target, you're 4% nominal, you're going to hit the zero lower bound, and then you're in this uncomfortable position of having to QE, and nobody likes doing that for lots of different reasons. So I don't think I think it makes sense to go to 3. Now, that's easy to say, not easy to, and I would never say that in the current context, because it's really important to keep inflation expectations completely hammered to the ground, because that's going to make it easier to get back to the inflation rate that you feel comfortable with, the 2% inflation. So I would never intimate anything like that. But I guess what I might argue is it's not necessary to sacrifice the economy to the altar of a 2% inflation target if no one believes in the 2% inflation target. I mean, it's like, come on already.
Yeah.
So what it means is you just get a little bit more relaxed about things, once you're in the 2s, and it feels like you're heading in the right direction, not headed back up for whatever reason. And then you just, you take your time, and things happen and circumstances change, and the political environment gets to a place where you say, okay, hey guys, we decided it's 3, not 2. And by the way, the Fed changes its policy framework, not every year, but on a consistent basis. And so they can, like they did back, was it August of 2022, when they adopted kind of the 2% is not a ceiling, it's an average through the business cycle kind of concept.
Right.
Which makes a lot of sense to me, but they can use the same kind of thing, and they can finesse it and get it to a higher level. So I would, the mechanics of actually doing that aren't easy. I certainly wouldn't engage in that kind of conversation in the current environment.
Mm-hmm.
But I think that I would not be wedded to, I'm going to push this economy into recession to get to a 2% target. That, again, I'm pretty sure if you ask most Fed officials, hey, what target would you think is appropriate today, 2 or 3? The vast majority would say 3, not 2, I think. Yeah.
Can I just follow up on that briefly?
Yes, please, Larry. Go ahead.
Because I basically agree completely. And just to amplify, I think the Fed's in an uncomfortable position, because I think on the one hand, as Mark says, it's very important to say publicly, we're going to get it down to 2.0. That's our goal, to anchor expectations. So they need to say that. On the other hand, it seems imprudent to actually try too hard to make that happen very soon. So really, it seems the optimal policy is to talk tougher on getting to 2% than they really act. Now, of course, on the other hand, the Fed says we want to be transparent. So announcing a target you don't really try to hit is not that transparent. So I don't know what the answer is, but it's a tricky situation.
Right. Okay, well, thank you both. I mean, we're not letting you go. We'll come back to you, but let's bring in some other people into the conversation. I wanted to introduce my friend, Gay Korora-Ton. As I said, she was for a long time at the National Association of Realtors and has now moved to a real estate position in Miami. Gay, you'll have to tell me what that is. I'm sorry.
Well, first of all, thank you, Prakash. And Mark Zandi has said it just blows him away to be with Professor Ball. And I'm blown away to be with Professor Ball and Mark Zandi. But anyway, I am now the chief economist of Miami Realtors. I joined them a year ago.
Okay, thanks. So, Gay, I wanted to bring you in both because of your recent posts about being worried about the PPI, the Producer Price Index numbers that came out yesterday, and also because perhaps you can shed some light on how the housing, the shelter component of the CPI is doing, and if you have any views of your own as well as questions that you want to pose to Larry or Mark. So the floor is yours, Gay.
Yeah, thanks, Prakash. Well, let me reverse that. I want to, comment first about, the effect of housing on CPI. And I agree. For me, I think it was mostly a supply shock that led to the high inflation rate in 2021. And then, of course, the Ukraine war, 2022. But now I think what we're seeing is the effect of housing on inflation. And I was just looking at the numbers and making the computation. If so housing 0.6% month over month, that contributed about 90% of your monthly change in the CPI on your index less food and inflation. So 87% to be exact. So really, how do we get to really bring down inflation? The focus is now on housing, and I agree, with Mark that yes, and of course, you see that rent growth has been slowing, 15 to 20%. It's now down to less than 5%, depending on the data, like apartmentlist.com or realtor.com would even say negative. The Zillow index is 5, but yes, I agree. There's pressure for rents to go down. But at the same time, I am also worried on the effect of higher interest rates on the supply of housing. So, supply and both demand, right? 7.5%. The median mortgage payment on just a $400,000 housing, $2,561. Median rent, $1,400. That's about $1,000 difference, right? So clearly, the preference is to rent rather than buy a home, and it's interest rates continuing to rise, so there'll be that pressure on the demand side. And on the supply side, and Mark also alluded to this, the banking system is shaking. And if you look at the construction and industrial loans, those are not growing as fast as they did, about 15% back in March prior to the banking crisis, the regional banking crisis. C&I loans were growing at about 20%. Then you look at the Federal Reserve Board loan officer survey. 50% of them are now saying that they tightened their lending. And you look at housing starts. Housing starts for 5+ housing, they're less than 500,000 again. Single family less than 1 million again. So I think those pressure for people to still move towards rental housing, and then the effect of higher interest rates on supply, will I think put pressure still on housing. So I'm not quite as confident that we are going to see a rent slow down. And in fact, we've seen some kind of slight uptick again in rent growth and some slight decrease in rental vacancy rates. Of course, in places like Austin, Nashville, what else? Las Vegas, those are where rent growth is going down. So I'm still, those are my concerns, and I'm still not quite confident we'll see house prices go down because of those points. And then on the PPI, my point there really was, I guess, in line with what was the discussion prior to this. Is the Fed really going to sacrifice economic growth on the altar of 2%? What's the chance we'll get 2% month over month? Very little. And the PPI data that came out, is just, to me, a leading indicator. Achieving that 0.2% month over month, which will bring you to a 2% year over year, is something still it's difficult to do. So I think we, on the whole, I'd say yes, certainly we have gone far. The Fed has gone far in bringing down inflation, but has it declared its victory there? Again, as as our two esteemed panelists said, it depends on what you mean by victory. To me, I think 2%, 2% is going to be a very narrow path. I think 3% is a number that I think is more achievable. Oh, and question, I guess, on that note, if I may ask our panelists. So Mark and Professor Ball, I guess, can you explain more, or shed your insights also on what you think will be the effect of this high mortgage rate on the supply of housing? Because I think we're looking at the demand, but just on building construction and supply, and of course how that will affect.
Thanks very much, Kay. Very interesting points. Mark, should we start with you? If you have a reaction to.
Sure, yeah, thank you for those comments. All very reasonable sentiments. I mean, I would say I think about the near term and then I think about the longer term. But right now we're focused on the very near term, like the next 12, 18, 24 months. And in that period, I do expect vacancy rates to rise and rent growth to go flat to down across the country. The reason for that is mostly supply. I don't know if I mentioned the statistic, but there's almost on the nose 1 million multifamily units in the pipeline going to completion. Just for context, in a very good year, we have multifamily starts of 450, 500K. So that's 2 years worth of supply dead ahead coming into the marketplace in the next 12 to 18, 24 months. Under any arithmetic, that's going to mean higher vacancy and lower rents. And I feel like that's going to be very helpful in getting the growth in the cost of housing services down and inflation back in the bottle. The other thing I'd say is on the single family side, home building, that has been just and to complete that thought. So you should be focused on completions, not on starts. They're two different things in the next 12, 18 to 24 months. In the single family side, fortunately, the home builders and their mortgage units have effectively cut price. They have interest rate buy downs. They're providing other amenities and other features to the home to lower the effective price. And as such, new home sales have actually held up pretty well. Existing home sales have gotten crushed. New home sales have held up. And so single family home building should hang, it's down, but it should hang reasonably tough. It's certainly not going to go down to the degree that it has historically when we're in this kind of environment with significantly rising interest rates, Fed raising rates and mortgage rates rising. So we're going to get more supply on the single family side than you would typically get. So I think in the near term, we're okay. Longer run, totally agree. I mean, we not only should be thinking about, the near term, what it means for Fed policy and navigating through without going into recession, but longer run, back to Prakash's point about food and filling my gas tank and rent, the staples of life, these are critical things. This is what really matters in terms of the American people and their standard of living. We need more housing supply, right? I mean, we have a very severe shortage. We came into this thing with a severe shortage of housing, particularly, low price points and affordable rental. And we need to really think about policies that can help support increased supply for housing to address what will be, very elevated growth in the cost of housing services in the future if we don't address those supply shortages. And that's a whole nother podcast or webinar, but we need to think about that. But near term, I'm pretty, given all that's coming into the pipeline, it's all in the pipeline coming to completion. The arithmetic is pretty compelling.
Thanks. Larry, would you like to add something?
So I find rents very confusing. They're very important let me try to maybe express my confusion and somebody can comment. So I think we understand now that the price of shelter and the CPI lags behind market rents that you can measure on Zillow or somewhere like that for various reasons. Mark said that based on that and the fact that market rents are flat or decreasing, we should expect that to be passed through into overall shelter costs. An argument that I've heard is that, of course, the current flat or decreasing stage has followed a period of very rapid increases in market rents. And I've heard the argument that in terms of the level, that shelter costs have not yet finished catching up to the big increase in market rents. So that even though that started turning around, we still have a way to go. I don't know, Mark, whether you've done the numbers on that, but I should say this. I've been struck that this whole thing about rents is there's the highest ratio of commentary on Twitter to careful research on any topic I've ever seen. People are throwing anyway. So maybe Mark has some numbers on that.
So Mark, we'll give you a quick minute, but if not, we can also table this for a future seminar. But
okay. Well, just very quickly, that's absolutely true, and I think that's why there's been a longer lag than I would have expected for the recent weakness in rents to translate through. And it doesn't mean it's not coming. It's just more attenuated. And if you look at the data, it's already starting to happen. I mean, if you look at cost of housing services year over year, I'm making up the numbers a little bit, but roughly order of magnitude, we were peaking at 7% at the start of the year. We're now down to 6%, and it does, abstracting from the monthly data, feels like we're moving in the right direction. That should gather steam here as the effect that you described starts to wear off, and the decline in rents we've seen more recently starts to bleed through in the data.
I'm cutting you short a bit just because we have a lot of questions in the chat and in the Q&A. I'd like to get to that a bit, but before I do that, let me see if my colleagues have any questions. Oh, Bing, would you like to ask something at this point?
Sure. I want to leave some time for Larry and Mark to answer some questions from our audience. Maybe just quickly, one question for each. For Larry, do you think the Fed? I read recently on New York Times they were talking about the Goldilocks situation between the inflation and the unemployment. Do you think the Fed can achieve? It looks like because we have a very robust employment. At the same time, the inflation, kind of seems to be under control. Do you think the Fed can achieve the Goldilocks, in the near future, or at all?
Thanks. So that actually takes care of a few questions from the chat. So
okay,
go ahead, Larry.
So if Goldilocks means low unemployment and inflation settling at 3 or 4%, then I think the Fed can achieve that, and maybe is not too far from that. Again, we've discussed this already. The big question is, people put it dramatically, sacrificing the economy at the altar of getting all the way down to 2%. That's that's what might be tricky.
Bing, do you have a quick question?
Yes. Now, refer back to Felipe's first question about the fiscal policy and the monetary policy. So my quick question is, U.S. never had a soft landing before with a tightening of monetary policy. So this time it looks like we may have a soft landing. So I'm wondering if the expansionary fiscal policy was the reason, like the Inflation Reduction Act, fiscal policy. So,
yeah.
Larry, did you want me to take a crack at that?
Yeah, sure, take a crack. Yes.
And I think I understood the question. I mean, it goes back to the debate as to what's behind the high inflation, demand or supply. And the demand argument has been rooted in the significant fiscal support stimulus that was provided during the pandemic. The last piece of that being the $2 trillion American Rescue Plan that was passed in March of 2021, which does line up with when inflation really started to take off. I would say that that demand side impetus for growth did add to the inflation at that point in time, along with other things, including the reopening of the economy, the normalization of prices that were cut by businesses during the teeth of the pandemic shutdowns. There was a lot of other things that going on, but that stimulus, which was very significant, $2 trillion, a lot of that got into the economy very quickly. Stimulus checks, PPP, rental assistance, a long list of things. But I would point out that at that point in time, if you can remember back, that was deemed to be, let's call it good inflation, because we had been through a decade since the financial crisis of suboptimal inflation. And here we were, oh, look, we got inflation a bit elevated, we're getting the price level back up to where it would have been otherwise. We're good with this. This is good, no problem. And I think the demand side support to inflation started to abate as we made our way through 2021. By the end of 21, it was starting to fade. But that's when the pandemic reared its ugly head again. That's when the Delta wave of the virus hit. That's when supply chains around the world cratered, semiconductor plants shut down. That's when the vehicle prices went skyward because we couldn't produce any vehicles. And then we got into 2022, we got nailed by the Russian, invasion. And now fast forward to the current point in time, I think the inflation has very little to do at all with the demand side support that we got back in the pandemic. It was the stimulus that was provided in the American Rescue Plan too much, in the context of the economy that we were facing, probably in hindsight. But just like for the Fed, this was March of 2021. We didn't even know if the vaccines were going to work. We were all lining up to get vaccines. It was still, on high alert. So again, risk management 101 says you do more rather than less. And here's the other thing I'd say that's important to keep in mind. It was a bigger package than I think, an economist would say, this is what we should do. But that you have to put it into a political context, a political economy context, because if you're sitting making policy and you got to get this thing through Congress, you're saying to yourself, I got one shot at this. I don't have two shots at this. And suppose the pandemic goes off the rails in a few months. I need state and local governments to have cash sitting in the banks to help me out here if this economy is going to go off the rails. So from a political economy perspective, you say, I'm going for the whole enchilada because I don't know how this thing is going to play out, going forward. So yes, demand played a role, no doubt about it. But that was 2.5 years ago. I don't think it's playing much of any role at this point in time. Certainly not the American Rescue Plan.
Okay, thanks very much, Mark.
Sorry, you got me on a rant. I could. Sorry about that.
I think with the benefit of hindsight, we were a little too stingy on fiscal after the Great Recession. We were a little too giving during this. On average, we did right, but it's all with the benefit of hindsight. We do have a couple of questions. We have actually several questions, and I want to thank my student Molly Liu, who's been monitoring the chat and sending me compiling the questions. So Molly, you can turn on your camera if you want for a brief thanks, or you don't have to. But anyway, Molly's been compiling the questions. So there are several, but at least two I wanted to get quick reactions from Larry and Mark. One is this whole thing about greedflation that was going on. Isabella Weber and all was saying inflation was due to corporations being greedy and so on. With the benefit of hindsight, with the benefit of where we are now, do you have a view on whether that was an argument, or whether that was a reason for the high inflation, whether there is something still to worry about, or that's a debate of the past?
So I have a view on that. I think that cannot possibly be the main cause. It's not that just exogenously at a certain point in time, businesses got more greedy and started raising prices more. I think there were the fundamental supply and demand things that triggered inflation. But that being said, I'm not sure anybody really has researched this very well, but it's plausible to me that that could be a factor. I mean, normally in a time of very low and stable inflation, if a firm raises its price a lot, that sticks out and customers think, why are they raising their price? That's not fair. So firms are not able to do that so well. In the last few years, everybody knows there have been these crazy shocks in the pandemic, and prices are generally rising very fast, very erratically in different industries. And there's sort of lots of good reasons for prices to be rising in certain industries. I think in that environment, it's a little bit easier to, raise prices along with lots of other people and, hope that people will attribute that to, well, it's a crazy time in the pandemic, as opposed to, the firm trying to exploit the customers. So I think it's plausible that's a factor.
Mark, you have a view on this?
I would agree with Larry. I mean, I think the way I think about that is I just look at profit margins, and profit margins rose during the pandemic, at least initially. And so that would argue that, yes, businesses were able to jack up prices more than the growth in their input costs. I will say though, margins are coming in pretty fast now, right? So, it's actually starting to weigh on inflation now. And my guess is when we get the data for end of year, early next, margins will be back to where they were pre-pandemic. So we've come full circle here. But you could argue that some of that inflation we saw certainly in 2022 coming into 23, before margins kind of rolled over, I think businesses were using that to their advantage. What's that old adage? Prices go up like a rocket, come down like a feather. You see that in every market to some degree.
Right.
It's just natural. And until the competitive, the kind of the competitive structure of these markets take hold again and they drive the prices back down, the margins back down to where they were, you can see that. So, I think that's kind of the dynamic we saw here.
Okay, well, thank you very much. Sadly, we are out of time. I want to thank Larry Ball and Mark Zandi and Gay Gororaton for helping us launch this new webinar series. Thank my colleagues, Oh Hu and Bing Zhao. So this has been a great start. I'm really appreciative of all the questions that have come in on the chat and the Q&A. We will try to get those answered, but I'm afraid we've run out of time on this particular occasion. So thank you all for joining, and we hope to make this a regular feature. And so we'll see you in Engaging Economics. Bye-bye, everyone.
Bye, everyone.
Right.